There is a quiet, profound deception embedded in how most people look at a stock ticker. We treat a flashing green or red number on a screen as if it were the pulse of a living business, completely forgetting that behind that quote lies a physical operation of trucks, warehouses, employees, and cash registers. When you hand $10,000 to a typical market participant, their immediate instinct is to ask what that money will be worth by Friday afternoon. They want movement, they want excitement, and they want validation. Yet when a student of Warren Buffett looks at that exact same $10,000, they do not see a trading chip for a casino game. They see an ownership stake in human productivity. What happens when you completely strip away the daily noise of the financial media and view a modest sum of money not as a ticket to fast speculation, but as a silent partnership in a durable commercial enterprise? The answer reveals the foundational secret of long-term wealth creation, a secret that has less to do with complex mathematics and everything to do with shifting from the mindset of a bettor to the mindset of an absolute owner. Think about how ordinary commerce actually operates in the physical world around you. Every single day, millions of people walk into stores, subscribe to services, and buy products out of sheer habit or necessity, transferring tiny streams of cash directly into the coffers of well-run corporations. When you buy a stock, most people assume you are just buying paper to sell to someone else later at a higher price, a dangerous psychological trap known as the greater fool theory. Buffett completely rejected this premise decades ago, adopting instead the wisdom of his mentor Benjamin Graham, who insisted that a share of stock is a fraction of a real business. Imagine owning a tiny sliver of a local brick-and-mortar storefront that quietly clears a steady profit every single week. You wouldn't stand outside the front door every 5 minutes demanding to sell your share back to a passing stranger just because the weather changed or a rumor swept through the neighborhood. You would look at the cash flow, look at the loyal customers coming through the door, and feel a deep sense of security knowing that time is working directly in your favor. Why then do intelligent people completely abandon this common-sense logic the moment they log into a digital brokerage account? The culprit is the psychological illusion of liquidity. The fact that public markets make it terrifyingly easy to panic, sell, and disrupt a brilliant business partnership over momentary market turbulence. When you treat $10,000 as a collection of fractional business ownerships rather than a speculative lottery ticket, your entire emotional relationship with risk undergoes a radical transformation. Consider the anatomy of a true business owner. They do not care what the daily valuation of their private bakery or logistics firm is on a random Tuesday, because they are focused entirely on the durability of the revenue engine underneath. They ask fundamental questions that speculators never bother to consider. What happens if raw material costs rise? Can this company simply pass those costs on to the consumer without losing market share? That single capability, pricing power, is the ultimate shield against inflation, economic downturns, and competitive threats. If a business can raise its prices aggressively during tough times because its customers have no viable substitutes, it possesses an economic moat that protects its cash flows like a fortress wall. Buffett spent a lifetime hunting for these exact operational moats, identifying businesses whose products are so deeply integrated into daily human life that customers treat them almost like utilities. Think about companies that sell everyday consumables, insurance policies, or indispensable software. People buy them not because they are trendy, but because their lives or businesses would grind to a halt without them. When you allocate $10,000 into a cluster of businesses possessing these characteristics, you are no longer betting on market sentiment. You are collecting a rent on human habit and institutional necessity. Yet, knowing what a great business looks like on paper is only half the battle, because the market rarely hands you these wonderful assets at a fair price unless something is deeply wrong with the surrounding sentiment. This brings us to the psychological hurdle that trips up almost everyone trying to build wealth from a modest starting point: the unbearable agony of waiting for the right pitch. Buffett often compares investing to baseball, noting that the greatest hitters in history do not swing at every single pitch that flies past them. They stand at the plate, completely relaxed, ignoring the jeers of the crowd, and wait patiently for a pitch right down the center. In the stock market, you are allowed to let 10,000 pitches pass by without penalty. There is no umpire calling strikes against your patience. Yet human biology hates inactivity. Our evolutionary wiring tells us that doing nothing while others are active is a sign of weakness or missed opportunity. When the market is booming and everyone around you is bragging about overnight gains in speculative tech stocks or meme assets, the pressure to conform becomes an almost physical weight. You look at your modest $10,000 sitting quietly in cash or steady compounders, feeling dull and left behind, while your peers seem to be sprinting ahead. That emotional vulnerability is where the vast majority of fortunes are quietly amputated. People trade their disciplined, long-term business ownership model for a ticket on the latest emotional bandwagon just to quiet their own FOMO. What happens when that bandwagon inevitably hits a wall? The panic that follows is swift, brutal, and completely self-inflicted. To turn $10,000 into a lasting empire, you have to develop a rare psychological armor: the ability to feel utterly immune to the financial gossip of the crowd. Imagine sitting in a room where everyone is screaming about a fire while you are calmly reading a book, knowing the building is made of concrete and steel. That is the exact emotional posture required to navigate public markets without losing your mind. When a severe market correction hits, and history guarantees that one will arrive sooner or later, the speculator views it as an existential crisis, while the true business owner views it as an extraordinary clearance sale. Why would anyone panic when the fractional shares of world-class businesses are suddenly marked down by 30 or 40% for reasons that have nothing to do with their long-term earning power? The irony of human psychology is that when department store clothes go on sale, people line up for hours and cheer for the discount. But when stocks go on sale, those same people run for the exits in absolute terror, swearing off the market forever. Overcoming this deeply ingrained biological reflex is what separates the accidental investor from the generational wealth builder. Let us trace how a modest sum actually scales when paired with this level of emotional discipline and business clarity. Suppose you deploy your $10,000 across 3 or 4 exceptional, cash-generating enterprises led by rational, shareholder-aligned management teams who allocate capital wisely. In the early years, the absolute dollar returns will look painfully small. A 15% return on $10,000 is $1,500 in a year, an amount that cannot buy you a luxury vacation or change your lifestyle in any noticeable way. This is the exact danger zone where impatience whispers that the strategy is broken, urging you to take on dangerous leverage, chase high-risk derivatives, or abandon the process altogether. People fail to realize that compounding is backloaded by design. The first decade is spent building the invisible foundation, laying down deep roots that produce no visible fruit above ground. During this phase, you are not growing wealthy, you are merely building your tolerance for boredom and refining your temperament. If you can survive the quiet years without interfering with your portfolio, something magical happens as time marches forward. The math begins to accelerate in ways that defy human linear intuition. The earnings generated by your underlying businesses are retained and reinvested at high rates of return, generating earnings on top of earnings, creating a compounding loop that feeds itself without requiring a single extra dollar of effort from you. By year 20 or 30, the curve bends upward with astonishing verticality, transforming that initial modest stake into a sum that shocks everyone except those who understood the mechanics from the beginning. Buffett didn't achieve his legendary status by finding a secret stock market hack that nobody else knew. He achieved it by refusing to violate the basic laws of human psychology and business economics. He understood that intellectual brilliance is vastly overrated in investing, while emotional stability, intellectual honesty, and an insatiable curiosity about how businesses make money are worth more than a room full of advanced degrees. Think about the sheer simplicity of his daily routine: reading annual reports, studying competitive moats, and waiting patiently while the rest of the financial world exhausts itself in a frenzy of unnecessary motion. When you internalize this philosophy, your entire relationship with money changes from an exhausting source of daily anxiety into a calm, systematic journey of observation and ownership. You stop watching the daily financial news cycle because you realize it is nothing more than entertainment designed to provoke emotional reactions rather than convey economic truth. You stop trying to outsmart brilliant quants and algorithmic traders on Wall Street, choosing instead to let the boring, unstoppable compounding power of great businesses do the heavy lifting in the background. $10,000 is no longer a tiny, insignificant sum to be gambled away in a desperate attempt to skip the line. It is a serious seed planted in fertile ground, waiting for the patient seasons to pass. As you look at your own financial path, ask yourself a quiet, honest question. Are you building a wealth machine designed to last for decades, or are you just renting a seat in a very expensive, high-stakes emotional casino? The choice has always been entirely yours, and the market will gladly reward whichever path you decide to walk. If this deep exploration into business economics and wealth psychology challenged how you look at your capital today, hit that subscribe button right now, drop a comment below sharing your biggest realization about emotional discipline, and share this video with someone who needs to stop trading and start owning.